The disclaimer, I do need to mention it. Obviously, we mention a lot of stocks in this presentation because we do own quite a few little interesting stocks. But at the end of the day, please do your own homework. Don't rely on what's in this presentation, and it's all very much general advice only. We've added 2 words to this title, the words being obviously competitive advantage. I know many fund managers will obviously present and obviously profess to have a competitive advantage. We may value stocks differently or have a different thematic process. But in my view, these are probably the 8 key points that really do set NAOS apart and really do give us a competitive advantage over the longer term. So I know people like to pigeonhole us as either a value manager or a growth manager. I know it's very topical these days with growth been in vogue now for so long. At the end of the day, we invest in businesses that represent value today, but we want them to grow over the longer term. So reasons not to invest in NAOS, and this really just hits the nail on the head on why we are different and what you need to consider before you do invest in or even consider investing in a NAOS fund. We are long-term managers, so if your time frame for an investment is less than 5 years, this fund's not for you or any of the funds under the NAOS stable. As you can tell, index returns and NAOS returns can differ significantly as they did last year. Clearly, we underperformed significantly last year. We've gone through periods where we can outperform significantly. Just trying to look forward on how we're managing our portfolios, or try to look forward into the future. And clearly we run a concentrated portfolio, so everyone's always asking me and the team, well, how do you mitigate your risk against stock-specific issues? Clearly we're not going to get everything right, but I think there's a number of, key points that you can implement to try and minimise your stock-specific risks. So people would know we invest in businesses that tend not to be very geared, so they can get through a bad period. We try to invest in businesses in this case that in industries that are growing. I've made the mistake before that you invest in a value business that's in an industry that's going backwards, even at a small pace, and it always ends in tears. I used the example a few days ago that anyone's seen radio data for all the listeners of radio. Unfortunately, it was down another 1.8% year on year, the advertising spend in radio. Radio has been very resilient for a long time, but it does seem like it's death by 1,000 cuts. And even though some of these businesses may represent value, it does mean the pie is getting smaller. So everyone's fighting very hard for a smaller piece of revenue. In saying that, we think there are 3 areas where you can still invest where the pie is definitely getting bigger, and these are the 3 that I'll speak to. The one no one likes talking about, the ageing population in Australia. There are 4 points that we'll touch on here, and the first one is I will happily say we were an investor in an aged care business a couple of years ago. Happily say we got very burnt because we didn't see the Royal Commission coming. But in saying that, the Royal Commission is due to end in the next 6 to 12 months. And we do, as we said a few years ago, we do believe the aged care industry has to go through some radical change. If you just look at the baby boomers alone, the amount of people who are going to be over 65 or even 70 in the next 5 to 10 years, it's a significant amount of people. You're talking about millions of people. Cyclical businesses, clearly we've gone through reporting season. We've seen a myriad of businesses of all shapes and sizes. But a lot of people went into FY19 reporting season thinking that consumer was very much down and out. You still see a lot of press about it. But it almost hasn't been the case where expectations were just so low that now it seems like there's a bit of mean reversion and people feel like some of these businesses probably represent value, and the consumer isn't as bad as what people think. It's very much a confidence thing, probably a bit like funds management businesses. But what you did see is, an example, as I spoke to before, but motorcycle holdings. New motorcycle sales have been negative for 2 years in a row. July, August have been the first 2 positive months in the last 24. And I can probably almost guarantee you there's nothing more consumer discretion than people buying a motorcycle. What we think leads to that is obviously if you look at auction clearance rates in Sydney, for example, everyone's very interested in those. People feel a bit wealthier because obviously they feel like auction clearance rates are up. They feel like their house is worth a bit more, gives them a bit more confidence. Tax cuts are being implemented over the next few months, although it won't be today, but over the next few months that will be a beneficiary or a benefit to retail facing stocks. And as I said, a lot of feedback that we had from people that you wouldn't expect it is it definitely has been more upbeat. Even in the building space as another example, yes, apartment buildings are off, but there definitely feels like there's a lot of work around in the commercial space, even the infrastructure space, as I've mentioned before. I don't think people are shooting the lights out, but it doesn't feel like earnings are going backwards at a rate of knots either. The last one I'll touch on is infrastructure and the maintenance spend. I've spoken about infrastructure a bit, and I think we've very much come to the reality that anyone who's building infrastructure tends not to make an awful lot of money. It's the people who maintain the infrastructure that's where all the money is. Some of these contracts, if you're building a toll road or an airport or a hospital for that matter, these assets will be around for decades, and they need to be maintained by businesses that can maintain them, that have the workforce to maintain them. Everyone thinks, anyone can maintain them. But at the end of the day, if I'm a YMCA, for example, I've got properties all over Australia. If I could find a service provider who's got a national workforce who can maintain my air conditioning, my heating, my electrical, whatever it is, my plumbing, and I can do it through one provider, then that's pretty compelling.
Now, coming on to some of the core holdings, we often talk about these businesses, so I'll try and be relatively quick here, but start with BSA, which is a field services business. And if you've been to one of our roadshows before, particularly in the last 6 to 12 months, you would have seen us talking about BSA and the fact that there's a legacy issue within that business that was causing a lot of downturn on the share price and a lot of loss-making. There was no profit there for the business. Pleasingly, we can sit here today and say that has been eradicated and resolved from the business, hence why we've seen a re-rate subsequently into FY20 and beyond. So why we like that business from here going forward, they're a key beneficiary of the NBN. And when you think of NBN, you don't often think of beneficiaries because it has been an absolute disaster. But these guys do a lot of the maintenance and the connections for the NBN. And going forward, the NBN is not a static beast. For whatever reason, with the technology mix, with what it is at the moment, it's going to need constant upgrading and constant maintenance. And BSA are a key beneficiary of that, as I've suggested. Furthermore, they do a lot of maintenance work for a lot of nationwide operations in terms of the YMCA, as an example, and they do a lot of tunnel work. So any sort of infrastructure work in the fire space, these guys are a key beneficiary there. BTC Health, this is a relatively new one that we haven't talked about too much in the past, but to quickly summarise, it's essentially the band getting back together on this company from a previous investment which we held, which was very successful, called Acrux. It's a pool development fund, and as was Acrux. And when the team who ran Acrux, they IPO'd it for $70 million. They ran it till it had a market cap of $700 million, and they generated approximately $250 million worth of dividends during that time. It's the same team that are now involved in this vehicle. It's in medical supplies and distribution. FY19, yes, we've seen the share price correction there, but what happened was they made a key acquisition, raised some money, and we've seen the benefit of that flow through into FY20. There's a long pipeline of growth opportunities for this business in Australia. Thirdly, Enero. It's been our core holding since day one of this vehicle and across the NAOS business. It's had a great FY19, as you can see there. It's our group of marketing and PR companies. FY19's performance was pretty much driven by their growth in the US market. They've got some key PR assets there that grew approximately 3 times their profit throughout FY19, and pleasingly we've seen that continue into FY20. The balance sheet's under-geared, and we feel they've got plenty of ample opportunity and capacity to be able to grow further in the US market. Finally, CML Group, again a core holding of the NCC portfolio. FY19, the way I think about that business was there was nothing that fundamentally went wrong with it, yet what we saw was a severe liquidity restriction from the micro-cap end of the market, and CML Group were a key, had that key influence on their portfolio and their share price during that time. Pleasingly, going into FY20, they've made a key acquisition in the last couple of weeks of a business called Classic Finance Group. And what that does, it gives them scale in 2 key areas which they were only just starting to operate in, and effectively speeds up their process into new markets by approximately 2 years. It's a business that trades on a single-digit PE, has an excellent yield, and has an EPS growth profile which is very strong. So we're very happy with that being a core position going forward. Coming to the key holdings here, so MNF is one we've talked about a lot in the past and is a very key holding across the business for NAOS. FY19, as you can see by the share price performance there, was not a good year. And I think why we can summarise that was the market didn't understand what they did. They had a few key areas of their operations which we believe were non-core that have penalised their overall earnings profile. In FY19, I think as a group, we took a lot more of an activist role in terms of how we engage with boards and management teams around positioning their businesses for the market. And we feel we put in an awful lot of work with M&F in terms of how we can help that company transition to be a better looking optically company for the market and simplify their story and make it so that investors focus on what matters. Pleasingly, we've seen that at the FY19 financial year result, where the company really simplified their business, focused on key customers, which include companies such as Microsoft, Google, Amazon, and it's all about communications. So just as like the mining services companies, you've got picks and shovels that help out with the miners. These guys are a picks and shovels business for the telco industry. They are a software company masquerading as a telecom company. Yet the valuation on this business is as a telecom company. We believe over time it should justify a software multiple, and we feel that the management team have the pedigree to be able to get it there. I've touched on Enero, so finally on Over the Wire, which has been a key holding for this portfolio for quite some time. It's quite hard to get exposure to the cybersecurity theme on the ASX, and we feel we can do this through Over the Wire. It's got a very strong management team, and they've executed excellently on a track record of acquisitions in the IT and IT services space. So FY19 was a great year for them. What happened in FY20 so far is an acquisition they made during FY19 had somewhat of a timing issue on an earnout. We think it's simply that, a timing issue, and the underlying core business is going very well, as is that acquisition, and the pipeline is very strong. With a management team that own 50%, we're very happy to be aligned with such a business. Thirdly, coming to NAC, which is our X50 mid-cap portfolio here. I'll skip over M&F and Smart Group I'll just touch on briefly. That was a business that does novated leasing and salary packaging. Business we know very well, an excellent management team and great returns on capital. Going into reporting season, we felt the market was undervaluing that business or penalising it too hard on kind of the macro issues. We took an investment there and have subsequently sold out post the re-rating as it's hit our justified valuation on that business. Thirdly, AP Eagers, which is the largest car dealership company in Australia that's obviously going through a merger that is now subsequently finalised with AHG Group. So they'll now have approximately 11% of the market share. Yes, the automotive headline industry has been tough, but what these guys, AP Eagers, have been able to do is consolidate, and now they have 11% market share, be able to generate significant cost synergies by buying the AHG business. But what excites us the most is the revenue synergies they should be able to generate over the medium to longer term, principally around things like finance and insurance, and also the ability that they'll have in terms of free cash to be able to provide that back to shareholders. We believe over time they could have approximately 15% of their market cap in cash available to benefit shareholders through capital management decisions. So it's a business that is above market, very much above market in quality, yet we're able to buy that at a below market price. And finally on people infrastructure, this is a workforce management business that we've owned since the IPO, run by a very capable individual out of Brisbane. And FY19 saw them make two very key acquisitions that are both strategic and EPS accretive for shareholders. In FY20 going forward, we feel that they'll be able to realise cost synergies and revenue synergies out of those two acquisitions. And underlying that is the NDIS thematic that Sebastian touched on earlier. We think the organic business as well can continue to grow at approximately 10% or plus. So we think that business, relatively low gearing and a very capable management team in a great tailwind area. So we're happy to hold that again going forward. Coming to the outlook, we often get this, you hold 30 companies, so what do you do for the other 300 odd days of the year? We do a lot of work behind the scenes on speaking to stakeholders of businesses that we know, and often as well, we always go out and see as many companies as we can. So we've just, as I mentioned, come through a reporting season. We would have seen over 100 companies throughout that period of time. We've always got companies that we're looking at or have known for a very long period of time before we're satisfied with investing. And I won't touch on too many of these here, but I'll just mention briefly Experience Co, which is a business we've known since the IPO back in 2015. It's a skydiving business. So what they do is they've basically got monopoly assets across Australia and New Zealand, great margins and a new management team because they went off stray and bought some very non-core assets. We believe the current new management team have the ability to rationalise that business and return it to what it is, which is a very good business at heart. And the existing opportunities. So often the way we invest is we have to be early a lot of the time. If you want to build up a 20% stake in a liquid business, have a relationship with the management team and know a business well, and then subsequently be able to provide growth capital in time, we have to be early. So some of the companies here, which I won't go through in too much detail, are kind of the next generation businesses that we've been able to, I guess, invest in and build up meaningful stakes over time, which we think should benefit shareholders over the next 3 to 4 year period. And coming to the bottom point there around our existing positions as well, fundamentally the reason we would sell a business is if it hits our valuation or there's been a change of strategy. And the 3 businesses there that we talk about, they've had a re-rate over the past little while, which in our opinion has been long overdue and justified. Saying that, the core underlying thematic in why we invested remains the same. Yes, there's been a re-rate, but we feel those businesses have got plenty more to go. And we don't invest in anything for a multiple expansion. We invest for today's earnings and the future that should hold without any sort of multiple expansions.